Did you know that resources have only comprised this small a portion of the ASX twice in the last 100 years? And both times it preceded a massive commodity boom that reshaped the Australian market. Well, that's just one of the eye opening insights that James Cooper shared in his mining memo email this week. Now, James has presented us with a fascinating paradox. While most analysts are bracing for iron ore's collapse under Trump's tariffs, he spotted how these very same tariffs might trigger the Chinese stimulus that actually sends these stocks soaring. Now, it's exactly this kind of contrarian thinking that creates opportunity when everyone else is heading for the exit. So when you overlay this century-spanning chart showcasing the rhythmic dance between resource and finance dominance, you start to see something that most investors miss. We might be sitting at a major inflection point, similar to what preceded the Poseidon boom of the 60s and the China-led resources explosion of the 2000s. So, James, welcome, buddy.
G'day again, Woody. Good to be back.
Good. Now, I've said a lot of stuff in that intro there, but you've covered quite a few things this week. So, looking at this sort of remarkable historical pattern that you've uncovered, resources currently at just 22% of the ASX after hitting lows of 15% in 2019. What specific parallels are you seeing between today's setup and those previous turning points that unleashed decades of resource dominance?
Alrighty, so this chart I just pulled out from the RBA. It's a really good chart. You'll see it in the mining memo.
We'll put it up. We'll put it up for readers to see,
We'll put it
for
up,
viewers to
yeah.
see.
And it just shows the relative market cap across different sectors for the ASX 100, so the largest 100 stocks on the ASX. It just gives you an interesting look at how much this capitalization has gone into, say, the banking sector or into resources or other sectors throughout its sort of 100 history that the RBA did its study. And it really paints a sort of another interesting way to look at the commodity cycle, because as we know, the ASX is heavily pegged to resource stocks. And as I detailed, it's about 20%. So across energy and materials, if you look at the ASX 100 by market cap, about 20% of that is allocated to resources. While that looks high, if you say compared that to the US 500, we all know that's a tech heavy sector.
Yep.
That's about 30% leverage to tech. So 20% is high, but historically speaking, for the ASX 100, it's actually quite small. So it has been as high as above, I think it was, I put down above 60, so 65% by market cap, which is a huge amount. And that happened in the late 60s with the nickel sort of Poseidon boom. So that was a real peak. But at 20%, we are actually at a sort of market cap low for the ASX allocation to resource exposure. So this just sort of paints a picture. Okay, if we're at a low point here, we've only seen this twice before in the last 100 years. So that was in the late 1990s, where it was around sort of 15%.
Yep.
And we all sort of know what happened after that. There was the early 2000s commodity boom, China-led infrastructure boom, which increased the market cap of mining stocks, which sort of put them back to sort of more normal levels within the ASX 100, which is up to about 40% allocated to resources. Then going all the way back to the Great Depression, resource allocation was only 10%. And what followed from there was a 40-year boom in commodities, which saw the ASX 100 gradually accumulate a higher and higher allocation to resources. So it's just this big transition that I potentially see coming as the ASX 100 sort of restores this sort of historic norm of larger allocation to resource stocks. And of course, that can only happen if valuations go up for these stocks, and that can only happen if we see higher commodity prices.
Yeah, no, it's a fascinating thing to do is to step outside and just look at it from a bird's eye point of view. It just takes you out from the day to day stuff that you're seeing. It gives you a bit of perspective. In your iron ore piece, James, you focused on that on Monday, I believe. You made an interesting point about how Trump's tariffs might actually benefit the sector through Chinese stimulus. Could you expand on this counterintuitive relationship and how it might play out differently from, say, the post COVID expectations of 2023?
Yeah, sure thing. So it's been our one of the key contrarian discussion points, and one of our trade opportunities for diggers and drillers that I've been focusing on really the last what would it be 6 months. So just taking readers back or listeners back sort of 6 months. So midway through 2024, there was a big sell-off in commodities and the sort of China theme because of big concerns about China growth, real estate market, deflation, all these things. So resources hit a major low in mid 2024. This was really peak pessimism in the resource market. And since then, we've seen a gradual pickup in sort of positivity for iron ore stocks. Back then, iron ore fell below $100 per ton. It's now back just above $100 per ton. So there is a bit more confidence, and it's certainly not as bad as it was 6 months ago. But as I pointed out 6 months ago, I told readers not to sell. We actually bought copper positions. We bought an iron ore stock. So it was a very contrarian play. And we've seen some strong early gains from those already. But I guess the important thing is with tariffs, so this is another sort of when Trump was elected in late 2024, resource stocks sold off again heavily on the sort of Trump expectation that he's going to be pushing China with tariffs. And this is going to slow down the economy even more. But the interesting thing is that the Chinese Communist Party, Xi Jinping, he came out in late 2024 and stated that they'll do whatever is needed to sort of lift confidence and business in China. So this just effectively means stimulus.
Yeah.
And we all know that iron ore is pegged to stimulus. So iron ore prices, that's been the case for the last 15 years. So we're seeing iron ore stocks really sitting at these sort of 2024 or multi-year lows. So there really hasn't been any kind of repricing from potential stimulus that's going to happen in 2025. So I think there's a real chance here that there will be a positive market reaction once we see China follow through with stimulus. And I think it will, because the CCP has been rather defiant. It doesn't normally lay out its playbook ahead of time and tell the market that it is going to stimulate. So I think there's a good chance that's going to happen this year.
In short, you're saying that that potential is quite underpriced at the moment. So that's an opportunity there. What specific signals would you be watching for that might indicate that the market is starting to price in that possibility, or is it purely just the price action that you look at?
I think it will happen very quickly. So once, because the market hasn't been pricing in any stimulus, and we look at what happened back in early 2023 when China reopened from its COVID lockdowns. So there was a lot of expectation built into iron ore stocks, copper stocks, based on the expectation that China was going to stimulate. Of course, it didn't do that. So no stimulus took place, and these iron ore stocks and resource stocks cratered because there was no stimulus. So today, it's really the reverse that's happening. We're seeing China actually commit verbally to stimulus in 2025, but the resource stocks aren't reacting to that. So they're staying staying in these low price levels, which I think offers a much better opportunity than what we saw after the COVID lockdowns, because the stocks remain tepid and the
Yeah, yeah.
opportunity is still there.
I was chatting to Brian, our colleague Brian Chu, earlier in the week, who's obviously his focus is in the resources market, but specifically in the gold sector. And obviously, the more later stage developers and producers have moved up quite strongly. His focus is on the explorers. Now, you've noticed that noted that in previous periods of resource underrepresentation, which has preceded massive commodity booms, are there, as of now, like particular subsectors within the resources industry that you might are looking at to lead that next rotation? So are you focused on more the explorers now, or is it where's your focus?
Yeah, so I think the focus would be, if you're looking at gold, I think there's still good opportunities in gold. Of course, it's had a really strong run in 2024 and the beginning of 2025. What I'd be looking for as an investor, maybe wait for a sort of smallish pullback, and if that happens, I think it will be a really good buying opportunity to sort of get into gold stocks, which I think um, probably a lot of people would have missed out on in 2024, or haven't really got as much exposure as they probably would have hoped for.
Hmm.
But in this sort of more, if we think of a pullback and then maybe another return to sort of a stronger gold prices in 2025, I think this is where we could see more speculative money come into the market. So we've seen gold stocks, large gold stocks like here in Australia, Northern Star, which have performed really well. And that's been on the back of a really good free cash flow,
Mm,
based on higher gold prices. Obviously, if operating costs are staying the same and you're getting more cash from the gold that you produce, your margins are going to improve. But what's important is, these miners really need to start thinking about future reserves. So they've been extracting gold. They haven't necessarily been putting a lot of money into future investment, and this is where the juniors that hold undeveloped projects, which really should be the focus, I think, in 2025,
hmm.
and potentially this sort of second round or second wind for gold that I probably see playing out after we see maybe a bit of a pullback. So getting a watch list of smaller gold juniors, I think is really probably the best way to play the second phase in the gold market, which is probably more likely
Yeah.
after we see a bit of a pullback.
Awesome. I've got a final question, and it's really about something that happened this week. The RBA cut interest rates, as we know. Is that going to have any effect on the resources sector from your point of view, James?
I see the resource sector as really a global uh, market. I mean, mining is not restricted to any one country,
Hmm.
and demand is not restricted to any one country, especially now with critical minerals. So the concentration is not so heavily tied to just China.
Hmm.
So in terms of Australia, I think for investors, perhaps it increases liquidity for smaller investors. Maybe that increases the amount of cash that they can put into more speculative stocks. So again, maybe it's a good sort of set up for putting for the smaller companies,
Mm,
because Australians are going to have more money to put into these smaller stocks. So
fair enough.
on a sort of micro level, I think there could be some positivity there, but I think more broadly, you just want to see if rate cuts are happening across the world. So especially US, I think that's going to be a more important driver, because that will lower the US dollar. Most commodity prices are priced in US dollar terms, and a falling US dollar is extremely bullish for commodity prices,
Gotcha.
and a higher, strong US dollar is the reverse. So I think I think, yeah, US dollar rate cuts is probably a more important factor, but it could have some. The Aussie dollar could have some strong tailwinds from that as well. So we'll see.
Cool. All right. Well, that's a good perspective there, James. And I guess the one sector that does benefit from that is the Australian gold sector,
That's right.
because obviously the Aussie dollar gold is at all time highs, and that affects the domestic gold market. And on that, we do have a really good presentation on the opportunities in the Australian gold stock sector. We will pin that presentation in the top comment below or in the description. I'm not sure what our video whiz will do, but it will be there. Do check it out. It's a fascinating discussion between our editorial director Greg Canavan and Brian Chu. But for now, James, thanks so much for your perspective on the resources sector. I'll keep following the mining memo, and it's completely free to subscribe to if anyone watching is not yet subscribed to it. So definitely do that, and I will talk again next week. Cheers, buddy.
Thanks, Woody. Cheers.